Hi there, Serial Trader here. Time for an update on the major US indices, and we'll start off with the SPX Elliott wave picture here. Now this is my currently we'll call it my preferred count, and that's where we have this ABC down for a wave W. Now we've had an ABC corrective rally up for a wave X, potentially in place now, completed, and then looking for another decline, three-wave fashion decline in wave Y to a new low below the March lows there. And some things I like to point out here, the overall fib retracement from the all-time high to the March low, we've rallied right up into kind of the fib zone between the 50% and the 61.8% retrace. That's certainly a nice area for a corrective rally to kind of stall and fail in. We have the relationships from this three-way move up between A and C, in between the 61.8% and equality relationship between A and C. Again, a nice area for a zigzag to complete. And then, of course, this parallel trend channel. It's a corrective move in that it's contained nicely within this parallel trend channel. And also the slope. If we look at the slope of wave A versus the slope of wave B, and let me just duplicate this. Hang on there. Okay. Yeah, so slope of wave A versus slope of wave C. You can see wave C is certainly shallower in slope, side by side there. So that's a nice feature of an ABC zigzag. If in fact this was a third wave, so like a 1 up, 2 down, wave 3 up in progress, ideally you would want to see an actual steeper slope and a breakout of that trend channel in a third wave, right? And we just don't have that. So certainly looking like a nice classic zigzag bear market rally here. So this is, again, my preferred kind of wave count scenario. But then if we go to my next, we'll call it the next best count I have. And that's where we have a wave 1 down, 2 up, wave 3 down, made the March lows there. This entire ABC up is a wave 4. And remember, I was talking about that 28.55 area as being the invalidation if we got wave 1-4 overlap, which would have me leaning more heavily on the WXY scenario. Well, we haven't actually ruled this out. We got very close. So yesterday we went as high as 28.50, 185. Again, the invalidation level was at 28.55, 84. So within a few points, but still technically no 4-1 overlap. So you could call this a 1, 2, 3, 4 as long as that high remains in place. And then that would be expecting a 5-wave decline here to finish off this impulse wave down in a wave 5. So this is still valid, although it came very close to being invalidated. It didn't actually happen. But directionally, it suggests, essentially the same thing, that we're going to go down and take out the March lows. So take your pick, but they both suggest more downside here. And those are really the two main wave counts I'm working here. The potential bullish count, where we're going to go up and make a new high here, and then this low will hold. I'm just not seeing it. If we get some unexpected strength to the upside and just keep pushing, see we push past the 618 retracement at 29.34, then we might start entertaining it. But even then, I have my serious doubts. But right now, that's not happening. We've actually begun turning back down here as of today. Okay, now on the hourly chart, just for a little more detail, this is a classic 5-3-5 zigzag. Okay. So we got our 1, 2, 3, 4, 5 up for A, ABC down for B, 1, 2, 3, 4, 5 up for C, and that's for either X or 4. And then we'll be looking to come down here in either Y or 5. So looking at this hourly chart, we're still within this parallel trend channel. It would certainly be, complementary kind of confirmation here to break down out of this parallel trend channel and not just find support on it and continue higher. So that's what I'm looking for here for a little confirmation. We do have, if you see here, a nice little island reversal here. Even on the hourly chart, you can see it. Now we came very close to invalidating that island reversal, but I'll get to it on the daily chart on the candlesticks. Technically still a bearish island reversal here, and you can even see it on the hourly chart. Okay, and you can see just on this hourly, you can see as we were making marginally higher highs, our hourly RSI continued to make lower highs, so that showed kind of the weakening upward momentum and the kind of the heads up that, hey, look for a turning point. And so far we've started to turn back down. A little early to really get overly convicted here, but definitely looking good here if you're expecting some downside. Okay. So that's really all I wanted to go through with the wave patterns. Not really huge changes from the last video other than pushing a little higher. But largely the outlook for me remains the same. Looking for us to turn back down here in a fairly significant way. Okay. Now on the Thinkorswim candlestick chart, well actually before I do this, what I will do is just go through position I put on here. Let's have a look. And just hang on. Okay, right now I'm into 3 SPX 2500 strike puts expiring on the 17th of July 2020. So that's my kind of core bearish position that I put on here. And let's see. So max risk 32,000 if I let them expire worthless, which I certainly would not do. And let's say we go down here to 2,000. That 30,000 will, give you about 120,000 of profit. If we go down to 1,600, that'll be 230,000 plus of profit off of 30,000. So if it's gonna go down and make new lows, these puts are really gonna work well. And if something else happens, then I know my max risk, very comfortable with that. And just going back to these targets, I'll quickly come back here to the trading view chart just briefly. Now let me just kind of get this dialed in just to show the reasoning behind the downward targets. And if we are just doing this WXY, a common relationship between Y and W would be equality, and that would get us down to 1650 on SPX. Another fairly common relationship would be the 618 relationship between Y and W, which would get us down to 2109. So those are some common targets. And if we are doing the let me get back to this potential scenario. If we're doing this, the 1, 2, 3, 4, 5 down, we'll do some common relationships. So the distance traveled in waves 1 through 3 off of wave 4. Again, you have the 618 relationship and the equality relationship. You also have, so basically the same as the WY relationships, essentially identical. But we also have the reverse fib, and we'll do that, the 1.382, and the 2 relationship. So those reverse fibs of this ABC up, that will get us to 1939 and also 1531. So we do, regardless of the kind of overall pattern that we're in, whether it's a 1, 2, 3, 4, 5 or a WXY scenario, very similar projections here. So basically between, let's just call it between 1600 and 2000 to 2100. That's really the reasoning behind the price targets, as long as we do actually start committing here and going down in a big way. But just some technical levels to look for, so that's why I'm using it to assess the risk profile here of these puts. And okay, 2100, that would get us, about at expiration 86,000. Currently, there'd be some premium built into that, so over 100,000. Again, 2,000 between, well, at expiration close to 120,000, leading up to expiration right now closer to 130,000. And if we go down to, let's just say in the 1500, so at 1500 it's 267,000, at 1600 it's 240,000, at 1700 it's 208,000, 207,000 roughly. So a lot of potential downside gains there off of a $32,000 max risk position. So that's really the reason for this. Now, this isn't necessarily the only thing I'm going to do, but I want to see a little bit more confirmation before I start selling futures short. And that'll probably be my next step here if we do get that confirmation. But for now, I just consider this kind of a core bearish position that I'll just leave in the background for now. I'm not going to try and be active with it. It's either going to work or it isn't, and I'm fine with that. Okay, so back to the candlestick charts here. So we do have, now if I just zoom in here, just to highlight that little island reversal there I was talking about. So far, we have a bearish island reversal. And I'll just go through what that means. So here you had a gap up from last week, I believe. Yep. So from last Friday's candle there, we gapped up, or no, correction. From Monday's candle, we gapped up on Tuesday. And then today we gapped down from Tuesday. And you can see the top of today's candle got very close to filling that gap. So to fill the gap, we had to go down, we had to go up to the bottom of Tuesday's candle, and that would have been at 2805.1. Today went as high as 2801.88. So technically the island gap is still intact, although only by a few points. And then we started to turn back down here towards the end of the day. So bearish island reversal, so that's a potentially powerful chart pattern, especially combined with the overall context of where we're at here with the L8 count and everything else. Just wanted to go through that. Now just zoom out here a bit. Technical conditions certainly look fairly bearish. And by that I mean we have a nice major moving average cross here. The 50-day simple crossing below the 200-day simple. That's the aforementioned death cross. We are up in the overbought condition here on the oscillator and just starting to turn down from that overbought condition. And of course the island gap and all that. Now we still haven't actually gone down and started closing below this T line. So that'll require a little bit more confirmation, but I think the early signs are here potentially of turning down here in a major way. Now if you want to be short and have a stop here, say you're using futures or an inverse ETF or something, whatever the equivalent levels on those instruments are, your stop would be against yesterday's high, which on SPX itself was 2851.85. So a fairly tight stop considering the potential downside room here. If it just takes off from here and really tanks, that's an excellent risk reward setup for that kind of trade. For me, I want to see it break down a little more. Maybe break this candle's low here, 27.21. Start closing below the daily T line. That would encourage me more to actually sell some futures. But for now, the SPX puts, I'm satisfied with that position at the moment here until I see a little more confirmation. Because you can't roll out that we just grind a little higher still. It's certainly possible. Although I do like what I'm seeing here, at least at these early stages of potentially starting to break down here. Okay, now didn't do a weekend video, so see if there's anything remarkable about the weekly candles. So last week we had a nice up week, and we're basically sitting around the weekly T line. And now, so far this week, we're not far enough in the week to declare what the candle will be. But so far it's kind of an indecisive doji star type week. So that could be a potential reversal week. We'll see how the week actually pans out there as of Friday's close, but currently that's what we're working. Okay. So that's really what I wanted to go through here on the SPX candle chart. Now, let's go to the Dow Jones Industrial Average. Similar setup. We don't have the island gap because we didn't have the same gap from Monday into Tuesday on the Dow that we have in SPX, but largely the same formation. Nice three-wave rally. Technicals are bearish. We're in a downtrend here on the overall, daily chart and the weekly chart. And obviously we're overbought here on this oscillator. It's the same setup here on the Dow, so not much to mention about it. And as far as the weekly candle from last week on the Dow, again, largely the same, hovering around the weekly T-line currently. And also the weekly 200 average on the Dow looks like it's potentially providing some resistance. Okay, so that is the Dow. And on the NASDAQ composite, a little bit different here, but I think it has the same implications overall. So we still have a three-wave rally off the lows, and we're running into some resistance right here around the 50-day and the 200-day simple moving average. So that's an interesting kind of confluence of resistance. It would be nice if we see it just kind of break down from here. And the death cross looks like it's looming here soon on the NASDAQ composite. The 50-day just getting ready to cross below the 200-day. We're overbought on the oscillator. So we have a gap up here, and right now we have not had a gap down on the NASDAQ, so a little bit different of a picture here. But I think this gap up gets filled as soon as we start getting some weakness and follow through. I think this gap's going to get filled and then some. And then, of course, if we start closing below the daily T-line, I expect the NASDAQ to go down here and break these lows along with the rest of the major indices. But interesting that, at least on a short-term basis here, this just looks a little bit stronger than the other two. But overall, still a three-wave rally. And now, again, major kind of moving average resistance there that we're encountering. Okay, now weekly from last week. What do we got here on the NASDAQ? Similar. Again, just a little bit more strength than the other two, but same idea. Okay, that's all I wanted to go through there. And some things to point out. So on the VIX, a bit of an update on the VIX. Still not enough to convince me that the VIX uptrend is resuming. But potentially we have a pivot there. And that would be the low of 37.31 on the VIX. That may prove to be the low. And you can see the oscillators in the oversold condition ready to turn up. Basically the inverse of where the indices are. Nothing overly grabbing my attention here on the VIX chart though. Not by itself. Now VXX, you can see we're starting to just dance around this 70 simple moving average on the 30-minute chart. If we start trading above and continuing above that 70 simple moving average, then potentially a new VXX uptrend is emerging. And that would certainly be bearish, because an uptrend in VXX would imply a downtrend in the overall markets, being that VXX is a volatility product. And actually, again, I'm not a big proponent of Elliott waves on volatility products, but this certainly looks like an A, maybe a A, B, C, D, E, triangle B, and then maybe a 1, 2, 3, 4, 5 for C. So it looks like potential A, B, C down on VXX, which would imply more than full retracement from its origin. So it would imply taking out the high there at 78.84 in VXX. Just a thought. Potential ABC down on VXX. Okay. Now on the VIX VVIX tool, I am seeing something that's kind of piquing my interest. And the conditions are here for a sell signal, and we're very close to confirming. So we had lower lows in VIX. We had basically a double bottom or perhaps a slightly higher low in VXX or on VVIX. So we have the VIX VVIX divergence there. We are just teasing to cross above the red moving average here on VVIX. So we're right there flirting with it. And then we're also flirting with crossing below the blue moving average here on SPX. So tomorrow or Friday or both, if we can get below the SPX moving average, get above the VIX moving average, and just start continuing that way, we'll have a confirmed sell signal here on this tool. But we're not quite there yet. We're just very close to a confirmed signal. But close isn't the same as a confirmed signal, so I'll just leave it at that. But I wanted to point it out. Okay, I'll just delete this. So yeah, that's my current take. I definitely think a bearish position is warranted. You know, you got to put the size on that you're comfortable with. But to me, I mean, this might be the selling opportunity of the year. We have a technical setup that suggests making new lows. We have an absolutely awful economic backdrop, which is not likely to improve in any major way and might even get worse over the coming weeks and months. And the only real argument you can hear from bulls is, oh, well, you know, the Fed will just print us into prosperity. I have my severe doubts about that. But we'll see. Anyway, that's all I really wanted to say for now. Serial Trader, signing off.